it's too late. The physical cat has already fled out of the COMEX back door, and it cannot be put back in.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, and from the entire Live from the Vault team, we want to thank you here for showing up. I'm going to show you how to subscribe in a second here, but this is the show that goes beyond the headlines to uncover the truth about the precious metals industry and the effects on the global economy in these historic times we're going through right now. We have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. And this show is an example. So my name is Shane Moran, by the way, and I'll be your host for this week's episode. And I'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver, both markets here, and we expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media just will not provide. But just before we go, head over to the UK here. Please help us keep spreading the word about this channel by hitting that like button. It really helps the show, and by sharing this information out, and subscribe if you haven't already done so. And if you click on that bell right there, we'll notify you every single time an episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, can we start off with a question here that you received from a well-known, highly respected US-based bullion dealer that you've known for many years? They were raising fresh concerns because the Fed is the only central bank still short gold, and that gold held in the U.S. may be confiscated. Now, what I want to do here, just before I get you to answer the question here, I want to read the exact question that was asked. He says, what do you think the probability is that they will try to confiscate physical gold in the U.S., given their gross short status? Will they go after the physical since they will need it, to say the least, in the very end here?
Hey, welcome to everyone. Nice to see you again, Shane. Yes, and I think this is a great question to start with. And again, I mean, the thing is, given this US-based bullion dealer is directly exposed to what we're exposed to here, the extremely counterintuitive US-centric COMEX-derived synthetic price capping action, which we talk about and why it happens. But what they're realizing is that the inevitable upcoming globally driven gold price revaluation event this year, which they completely subscribe to, will not just catch out the momentum-driven commodity trading advisors, let's just call them CTAs to save repeating it. These guys are the people that coattail the official gold market interventions. So this learned behavior, they've learned that it's profitable to hang on to these usual sell-offs. Now, what it's going to do is going to catch out the Fed, who is the only global central bank naked short gold. But this time, unlike in the 30s, this time history will not rhyme. So much has changed since we addressed this question over the years that we've been doing these episodes. And I thought I'd share this timely question and really a detailed assessment of this with everyone, as it really ought to be addressed. And actually, it is ultimately leads us down a very newly dug rabbit hole. So let's take this just one step at a time. And so following gold being reclassified by the Bank of International Settlements as a globally recognized first-tier asset class, that was just 1 year ago, Shane. I can't believe it. And this is, and it's just, this is, so it is, it's the only other first-tier asset class that is liquid enough to compete with and trade alongside US Treasuries. So, I mean, obviously, first-tier global liquidity providers are really of the opinion that it would be impossible would actually be impossible to confiscate physical gold held in the US. And we'll go through why. The US may try and tax it or find some other way of disincentivizing US ownership, but it's just not possible to contain gold's interconnectivity into the multi-trillion-dollar a year, and after Basel III legislation kicked in a year ago, net stable funding ratio compliant global foreign exchange gold market, meaning it had to be physically backed. So let's just remember this. Physical gold is money. It's plain and simple. And given its finite supply, once it's produced, delivered, it just cannot be debased. Now, if the US tried to confiscate gold, and I doubt all the states would actually go along with this either, the aggregate of all the US physical gold seized would only represent a tiny fraction of what is held globally by competing central banks and sovereigns, all of who benchmark the percentage of physical gold in their own gold reserve accounts to find a value for the percentage of gold backing every other global foreign exchange cross that they interact with. This is going to be more of a factor as we see Glasnev's gold-backed currency come into play. Now, let's not forget, gold is a global foreign exchange cross. It's not just a commodity, which is what the CTAs, the commodity trading advisors, just view it as that. Now, the largest holdings of US gold are really held in the various gold exchange traded funds, the ETFs, with GLD being the largest. Remember, we did a couple of episodes on the illusion of the ETFs. Look, a gold ETF does not represent ownership of physical gold. It's merely just a claim on it. So in the case of a financial collapse or geopolitical incidents triggering the BRICS nuclear revaluation event, it would potentially expose the holders of these gold shares to unfactored counterparty risk. Most of the gold and silver ETF shares are held by funds and CTAs who are mandated to invest in ETF shares, not the underlying physical bars. Now, while these ETFs are supposed to represent an equal weight of gold, the fact is they're ultimately interchangeable with fractionally held COMEX gold. And these ETF assets are used to hedge other risk investments, including short selling, fractionally held gold futures, and betting in highly leveraged option structures. Now, this leads back to the question we raised in our last few episodes. A gold market revaluation would force a bid-only race to cover these naked short derivative bets and could see many of these traders, think about the leverage involved, many of these traders and the brokers who provide liquidity for them to get carried out feet first. Now, considering the over-the-counter market on and off ramps between the ETFs and the COMEX market flow through the unallocated gold accounts of the various authorized participants. Who are they? The LBMA agent banks, who use this source of ETF liquidity to set and create synthetic price ranges. It's a lovely flywheel for them. But into a Lehman-esque rehypothecation event, good God, how quickly people forget 2008. The unknown question is, how much of this ETF gold will be locked up in administration if these banks, this daisy chain of banks, goes down? And aside from the obvious warning that ETF gold incorporates counterparty risk and negates one of the primary reasons for owning gold in the first place, the point I'm trying to make is how much of these large ETF holdings would be actually available to seize when all was said and done. And so even setting aside the risk and saying that they don't all collapse, into the process of seizing the US gold element of the above ground ETF bullion holdings, this non-Basel III compliant ETF gold would be squared for cash. And once the related gold loans were deleveraged, and many use gold derivatives to leverage these bets, the rewards of seizing this gold would be tiny in comparison to what is traded and held in the 10 times larger, one-to-one backed, physically backed NSFR compliant gold markets. Now, also, while ETFs back the price of gold bullion in the over-the-counter market, unlike NSFR compliant over-the-counter, the over-the-counter FX market, which actually sets the price, which is backed, this ETF exchangeability with COMEX gold means it's not fully compliant. So in the prospectus of many ETFs, there is openly a disclosure, there's a disclosure risk that the sponsor of the ETF fund may or may not hold the full allocation of physical gold bullion as well as some cash. So this is due to the fact that the ETFs can be shorted. And some can be some of them can be 3 times leveraged. In other words, ETF assets in aggregate do have a rolling double ownership claim on some of these investors' holdings. I don't think most investors realize this. However, in comparison, bought and paid for physical gold cannot be debased. You think about it, all the energy that went into creating each gram, each ounce, each kilo, each ton of bullion bars or gold coins lays within them. Whereas every one of the fiat crosses that are benchmarked against gold can be printed at will. So, in other words, they can be debased, meaning it requires an ever expanding supply of fiat currencies to buy the same amount of gold. And it's not that the gold price is actually going up. What we're seeing is that it takes ever more dollars and euros and pounds and yens to buy the same ounce of gold. Now, this is how the Fed has dug a hole in the first place. As the gold reserves they sold, leased, and swapped needed more printed money to buy back newly minted gold to square these underwater bets. Why? Because when they leased and swapped this gold, went into a marketplace, people grabbed it and bought it, and it was not returnable. So they had to rebuy it at a higher price. I mean, good God, the 8,133 tons of rehypothecated gold, if that's not a deep enough hole to have dug without making it worse, then, I mean, the head spins. This is because really seizing US gold would drive the Basel III compliant, fully backed, deliverable spot gold global price to explode higher, in the process shooting the Fed in the foot. It's too late. The physical cat has already fled out of the COMEX back door, and it cannot be put back in. Physical gold is money. And in my opinion, the plunge protection team, openly reported as active, are now far more worried about Bitcoin competing against the dollar. And that leads us into some cutting edge observations.
Yeah, Andrew, this is incredible research that you've done here, and it brings a whole new meaning. You know, when we say buy physical, buy physical, buy physical, you want to maybe rewind this a little bit and listen to what Andrew just said. Now, I know our subscribers are going to be keen to look at what you and your LPs have uncovered. Can you go in a little bit further into this?
Yeah, Shane. Over the last year, we've been tracking the outflows of synthetic COMEX open interest. In other words, the chips that are in play in the casino, and the direct relationship with the related interchangeable exchange traded funds. Now, following the launch of the 6 Bitcoin ETFs just a month ago, we've noted an actionable pivot point develop. And this is really right on the front burner. And this particularly came to light following our first year liquidity provider meetings over the last 2 weeks, since our last episode, this is, especially over the last 7 days, where it has become clear that an unprecedented dynamic is now in play, influencing the whole structure of the synthetic gold market. Now, this presents us a huge opportunity window, and this is why spending a bit of time talking about it so you can make your own decisions. Now, connecting the dots into a record over 1 trillion Bitcoin market capitalization now, of which over 20% of which was added in last week alone, commodity trading advisors have dumped in excess of 3 billion of gold ETFs into an over 4 billion stampede. I think it's closer to 5 billion stampede into the Bitcoin ETFs. Now, this helps explain the really strange counterintuitive sideways action when gold, that we know gold, has been in such strong geopolitically driven demand. Now, given the CTAs are the recipients of around 75% of all the COMEX gold open interest that segues into these ETF open interest level numbers, and which was, don't forget, we had Bloomberg attested to this. Remember, they noted the same group of specs control similar concentration in the oil markets. So we're talking about 75, possibly 80%. This FOMO-driven hot money rotation of COMEX gold market open interest into Bitcoin has, at the margin, changed the COMEX operating dynamics. Yet, so far, this has largely flown under the radar. And there are two very good reasons. Firstly, this exit of synthetic gold open interest into the Bitcoin ETFs is very good news for the officially intervened COMEX gold market. So let's dig into that. Firstly, this FOMO frenzy to fund this Bitcoin ETF and to get a piece of the action is evidencing an auditable outflow of a large swathe of, don't forget, 96% leveraged paper market COMEX supply, which incrementally reduces the bandwidth for officials to add and remove sufficient conjured up supply that is needed to lead an ever decreasing pack of led by those momentum CTAs, which they need to gain enough traction to really effectively intervene in the officially sanctioned COMEX-centric gold to dollar price setting process. Now, to put the implications of this outflow of open interest into context, as we highlighted in our last episode, we brought attention to the fact that at its peak in 2020, close to 800,000 lots of open interest of chips were floating around, loaned by the house to the speculators, and that represented about 80 million ounces, 2,500 tons, if you remember, but 96% unbacked paper gold warrants, pieces of paper that were made available to be traded every day. You only needed 4% to actually trade that kind of volume. And that represented all of the new gold mined every year being issued and controlled by the casino every single day. However, fast forward since our last episode, as of yesterday, as of Friday, we're recording this episode on Wednesday ahead of FOMC minutes tonight. Under 407,000 lots of open interest of chips remain in play. That's plus or minus 40 million ounces, not the 80 million ounces. And that really meaning very close to half of all the COMEX gold speculators have bailed out for one reason or another, and liquidity providers report this notably accelerated following the Bitcoin ETF launch. So secondly, and even more importantly, given the remaining inflows and outflows of COMEX open interest are indirectly interchangeable with the gold ETFs, this is where it gets really interesting. Many institutional CTAs do not have a mandate to directly trade gold, or even for that matter, in many instances, gold futures, with the majority of this group really restricted to trading ETF shares so as to gain exposure to gold, silver, oil, etc. Now, we see this fickle group of traders controlling, as I say, around 75% of all gold and silver open interest, switching horses into trading the ETF shares of Bitcoin. Now, this outflow of gold market open interest into dollar competing Bitcoin, and don't clock this, dollar competing Bitcoin, is drawing the unwanted attention of officials who, for the last over 50 years, have been actively intervening in the FX gold markets against the dollar and using the bandwidth generated by these captive, useful CTA fools um, operating in the siloed casino wars to add sufficient gold supply to slow down the naturally rising gold price against the debasing dollar, to create enough synthetic flywheel, basically. Now, this switch of official focus is not yet realized by gold market technical analysts, relying on historically anchored price extensions, which I continue to see them trying to extrapolate.
Now, Andrew, you had just mentioned here that the Fed started intervening in the gold markets. I'm thinking some 50 plus years ago. Coincidentally, isn't this when the COMEX was formed or was forming?
Yeah, bang on, and yeah, offsetting a long, really, what we'll do is look, cutting a huge long story short. Given that for over 5,000 years, gold has endured as the only true form of money, universally providing what we know is a medium of exchange, a unit of account, the critical things, store of value, the three critical things that make money, was able to correctly benchmark the price of labor, goods, and services into fair units of trade that are exchangeable, better than swapping a chicken or digging a trench. However, the moment that Nixon removed the exchangeability of dollars for gold in 1971 to stop foreign central banks from swapping their unbacked dollars for gold, it became necessary for the Fed to set up a synthetic unbacked fiat foreign exchange gold pricing mechanism, fiat backed, that was going to be liquid enough to benchmark a synthetic unbacked fiat foreign exchange cross with gold. So, in other words, create fiat gold. And this was the sole reason the COMEX exchange was born in December 1974. And it's on record that the Fed, in agreement with the Bank of International Settlements at the time and Western governments, they created this gold futures trading to allow the manipulation of gold at the expense of the producers. And the ability to add unlimited synthetic gold supply really served to contain the gold price, as well as to inject sufficient volatility to dissuade investments in gold. Think about that. It's about the volatility, the deliberately injected volatility. Wake up to this, Bitcoin guys, because, and I'm not saying Bitcoin's a bad thing. I see it as a fellow traveler. But when we when the synthetic created official benchmark to value foreign exchange gold price against gold, when that was put in place over time, containment of a synthetically divergent gold price began to get much more difficult. And following the March 2020 fracture of the synthetic gold price, we covered it live at the time, the COVID shutdown of the refineries really finally exposed the degree of the scam. And this is when all hell broke loose. The market changed at that point. What happened was, with no fresh bullion available, because it happened to be COMEX in this instance, COVID in that instance, the official agent banks providing liquidity to the 15 trillion a year FX gold markets, which is actually closer to 75 trillion when you add in all the derivatives. These banks that were supplying liquidity were overnight turned upon for delivery of the bullion that was really supposed to be backing these foreign exchange gold offerings. And this is when the degree of leverage and the illiquid nature of the LBMA gold market became fully exposed. It fractured it. The liquidity providers that were being turned upon for T+2, in other words, I'll buy it from you, I want it, and I need it, I'm under the regs, I get it in 2 days. This T+2 physical delivery of their foreign exchange long gold offerings had always relied on hedging these deliverable foreign exchange gold bets against this 96% leverage COMEX futures market, which historically is run. If we just figure in ordinary run-of-the-mill circumstances, yeah, you can probably manage that. because what you're doing is you're offsetting the short positions offset your exposure, and basically in a roundabout way, or at some point you can manage that, and because it's equal amounts of offsetting synthetic supply. However, what happened was the sudden realization that hundreds of tons of locked-in T+2 deliverable spot gold orders were being demanded for delivery, that they're 96% unbacked, is what drove the disorderly scramble to short cover these offsetting COMEX short hedges, which are worthless unless you can actually use them to cover, which by no coincidence drove the spot price to cover these bets 96% higher. And that's why we evidenced close to $100 an ounce premiums to cover these leveraged so-called hedges. So it's important to remember this was the pivotal point. This was actually the point when the Bank of International Settlements realized they needed to bring in net stable funding ratios, because the whole daisy chain of liquidity providers, first tier banks who are privileged to have gold accounts with the Bank of England, would have imploded. And while officials stepped in and bailed out these agent first tier liquidity providers from hundreds of millions of losses, they did lose hundreds of millions. HSBC, JP Morgan, and all these guys did. And they lost that, but then they halted the market. Now, it didn't stop people wanting physical. Many second-tier liquidity providers, LBMA sanctioned banks, suffered such large losses, and they permanently withdrew from providing foreign exchange market liquidity in gold. And we covered this in detail live as it unfolded, and it is no coincidence that the fracture of this relationship between the LBMA bullion banks and the CME leveraged futures market marked that apex of almost 800,000 contracts of COMEX open interest, marking the point that many of the second-tier banks withdrew COMEX liquidity as their compliance departments, reeling from massive irrecoverable losses, forbid them from acting as liquidity providers between physical and paper markets. So close was the collapse of the entire daisy chain of these bullion banks, exposed to, as I say, pretty close to 75 trillion of interconnected gold market derivative. This is why you get the daisy chain of one go down, like Lehman, the whole lot go down. This was by no coincidence the exact point Basel III NSFR requirements were brought forward to be implemented as soon as possible in January 2022. And we covered that in such close detail. So really, with the Bitcoin ETFs now capitalized in excess of over $1 trillion, these inflows exponentially are rising. And official management against this rising dollar foe has definitely got the attention of the plunge protection team, who are already battling with the largest de-dollarizing event since Nixon closed the gold window. So welcome to the club, FOMO chasers. Don't get me wrong, I see the benefits of Bitcoin as a fellow traveler to gold, but liquidity providers already report this ballooning threat to the dollar is getting far too much attention to ignore. So beware. If you're an investor in these, watch out for the volatility. Watch out for, they know where your stops are. Watch out as they switch horses into watching in managing the Bitcoin market. So what this is drawing officials' attention away from this shrinking gold open interest, which we've just described has halved since 2020 and is rapidly contracting. The PPT, the Plunge Protection Team, are shifting their hegemonic dollar support gaming, which is what it's about, to focus on this Bitcoin ETF. And guess who's going to take the short side? Of course, officials and the agent banks, who have had an almost exclusive hold on just enough gold futures market CTAs to be able to control the ranges in gold and silver futures. You watch the contrived volatility game transit into Bitcoin and out of gold. And as we said last time, Good riddance to this pestilent 75% held CTA COMEX-centric gaming fuel. Good riddance, guys. And as and as this rinsable synthetic open interest migrates elsewhere, the NSFR compliant, very strong central bank and sovereign driven deliverable spot gold market demand will exert increasingly more influence on officials trying to contain the synthetic market price. They will not be able to do it. And while we're not quite at the tipping point yet, the liquidity providers estimate it's very close and that a more physical market is evolving as the CTA gold and silver open interest reduces, while inversely this Bitcoin open interest expands. Complementing this bullish for gold setup, which it is, the current COMEX-centric CTA sell-off is generating a massive long insider-held gold and related gold and silver hand. Now, also liquidity providers report CTAs are reported to be selling gold and silver futures to fund Bitcoin ETF longs. This is it. I mean, it doesn't get any more leveraged than that. This is crazy stuff, and this explains the short-term pricing dislocations into very wide reports of physical gold buying, as concerns that a Middle East war is only just about to seriously escalate. And while these blinkered momentums chase this dot on a screen lower, the swapping of dollars for strong physical safe haven demand will see the commercials, the insiders who are making markets on the bid side, and dips in gold and silver will be short-lived. Now, this jives with our assessment that in order to survive, the COMEX is going to have to begin to reflect a physically deliverable price or be drained of every single ounce, kilo, and ton of these synthetic COMEX prices as they get alchemized. We talk about this. Of course, you've got a backdoor. The EFP backdoor is how you alchemize and actually force delivery of these COMEX positions. And that's what's happening. So very short term, we see China just returned into the mix after the week-long holiday. And as we expected, our contacts report this week that gold has now taken the place of cash gifts and is driving the strongest ever physical gold demand ever reported. That is a big change. It used to be money that was given. Now every single event, it's gold. This is complementing verifiable reports of strong spot gold buying into heightened concerns that a Middle East war escalation is only just beginning to get serious. And what is patently clear is the commercials exposed to the delivery markets are taking the long side of these blinkered momentum CTA sellers. And right on cue, under the smoke and mirrors short-term action, this is increasingly evident.
Wow, Andrew, this is information, like we say on Live from the Vault, that the mainstream media is just not talking about when it comes time to gold and silver, the physical markets. Now, Andrew, earlier you had mentioned something about silver. You know how I feel about silver, but you got me really fired up. And I know we had one of our producers on, and he was fired up too. But I can't wait for you to share this news with our community.
Yeah, Shane, I saved it to last. This is mega. I mean, mega. And you may have noticed that although somewhat synthetically subdued, the same actors' footprints in silver really has evidence silver leading the way higher for gold. And this is because gold rising against the dollar has been the official's intervention focus. But the necessary, as we say, the necessary CTA open interest required to offset EFP outflows are getting very close to being tapped out. So yes, Shane, on to silver. Silver, my friend, outside of the rigged casino bubble, we are now absolutely certain that that silver is coiling for an extremely a very large move, and the CTA-driven dips in silver are going to be jumped on by the pit managers. Now, we talked about massive Indian silver demand in our last few episodes, but what happened over the last few days is a doozy. This week, silver wholesale demand has reached unprecedented wholesale demand levels, and the dot-chasing CTA useful fools have not cottoned onto it yet. I can see that going on now. And this is mind-blowing stuff. But here's the fact. European refiners have all forward production sold out at the moment. And I'm talking about wholesale supply, wholesale bar prices. And it's all sold out at spot prices. And they're searching for more supply from any source they can. And we're all getting phone calls from refineries for any size. So strong is the Indian demand that they now could readily absorb over 2,000 tons at spot prices, which will not be possible to find at current spot prices. That is how strong it is. As the last refiner said to us this morning, if I could fill 2,000 tons now. And in an attempt to play defense, the so-called LBMA, London Professional Trade, remember we looked at them, how these guys operate. We did a whole episode pretty much on these guys. They're refusing to deliver wholesale bars. They have the bullion. They refuse to deliver these wholesale bars in any size at current prices, leaving every other known source dry. Now, they'll make sure at Samsung, Apple, etc., Kia and these guys get their silver. But that is purely to avoid a race for everyone to come after the same amount of irretrievable bullion at this price. What it would do is they would come in and they don't care about spot. They would just pay whatever it costs to get that assembly line running. So bottom line, silver looks ready to make a very, very strong move higher. This is unprecedented. And so what timing on it? Well, I mean, we have options. We have got FOMC today. So there's always some gaming. Maybe we see this rally after options expiry next Monday, or for first delivery notice a couple of days later, or even rollover and delivery at the end of the month. And then, of course, because then the contract then rolls over to the Bay contract. But I have a strong feeling that there's going to be so much demand, they're going to be coming into the COMEX and say, this is the only source of where it's the only source of where you can actually take delivery of physical bullion. And of course they're going to do this. And insiders are going to be forced, though, to ring the register on the CTAs who've been lured into betting against silver above 23. And they've been lured into selling it above 24. And they have massive bets they've made against 25. I'd say, Shane, watch out above, my friend. Now we've actually also evidenced the SLV ETF, the silver ETF, being now tapped on for supply. Well, you know where this is leading, guys. There's only one question. How much physical gold and silver do you own?
All right. Thank you, Andrew Maguire, for talking gold and also silver here. Remember, to our entire Live from the Vault community, buy physical, make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. Now, please help us keep spreading the word about this channel by hitting that like button. If you haven't already done so, do it right now. Hit the like button, share this information, and also subscribe. And if you click on that little bell right there, we will notify you as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.